Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to the latest edition of InvesTips from the CIO's desk. I'm Steve Brice and your host for the podcast. Today I want to talk about how to think about the different costs of investing. There's a saying that there are only two certainties in the world, death and taxes. But maybe when it comes to investing, we should tweak this as being the only two certainties are cost and taxes. Now, it's tempting to spend your time trying to minimize both, the latter in a legal way, of course. However, while both dimensions are definitely important considerations in both your investment strategy and your choice of investment vehicles, I believe the better framing is to maximize your returns after taxes and costs. In doing so, you are cost aware and tax aware, but you don't lose sight of the objective of investing, which is to grow your wealth. Maybe a good way to think about this is when it comes to spending. Not only do we pay taxes when we earn money, but we also pay taxes when we spend money in the form of a consumption tax, such as GST, VAT, or a sales tax. In theory, of course, you can minimize your consumption tax payments by buying as little as possible. But this is no way to live. A better approach is to be mindful when it comes to spending. Focus on what is really important to our physical and mental well-being today, while also balancing this with the need to save for the future. Again, this is not avoiding paying tax, but it's trying to optimize for the lifestyle you want over time. Now let's go back to investing and start with taxes. Different forms of investment returns, for example, dividends, interest payments and capital gains, may be taxed at different rates, which means investors may prefer one type of return over another. Meanwhile, there may be different tax rates for capital gains realized over different time periods. And there can also be withholding taxes imposed on certain investors based on the domicility of the underlying investment. The good news is many countries are keen to incentivize self-sufficiency in retirement, and as such have different tax shelters to make long-term investing more attractive. To the extent that you know that you will not need the money before retirement, these shelters should be prioritized first, and you should select investment vehicles that do not increase your tax liabilities unnecessarily. As well as taxes, investment costs are also important. Costs include things like transaction costs, management fees, expense ratios, and bid-offer spreads, the difference between the price at which you sell an asset and the price at which you can buy the same asset. A whole ETF industry has been developed around minimizing costs. However, again, balance is appropriate. For instance, my portfolio management team are focused on maximizing returns after incorporating the costs of different investment options. This does not necessarily lead to the cheapest option being chosen. As you would expect, there are many instances when paying slightly more in terms of fees can be rewarded by the outperformance of the investment. The final thing to think about when it comes to investing is the cost of your time. There are as many ways to invest as there are investors. I mentioned how my portfolio management team does this. But this takes a lot of time and judgment. And they do this full time and have taken many years, and in some cases decades, to learn the tools that they need to do it. An alternative approach would be buying individual stocks. This can be quite cost efficient, but it can be very time inefficient, especially when you incorporate the need to research the companies, monitor the stocks, and decide when/whether to buy or sell. Most of us are time-starved, and a lot of investors invest not because they're interested in finance or markets, but rather they know that they need to achieve their financial goals. This is where collective investment schemes such as funds and ETFs can offer different solutions and save you time and give you diversification. In summary, costs and taxes are important considerations when it comes to investing, but they're not the be-all and end-all. It's far more important to start on your investment journey and learn as you go. As you get more comfortable, then you can recalibrate how you invest to become more cost or tax efficient. Thanks for joining me today. That's all we have time for. Until next time, please take care of yourself.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.